Gold prices have been on an incredible run.
Price of gold
closing above $4,000.
Reaching heights it has never seen.
The value of gold rise to a record high this week. It is the biggest rally since the 1970s.
As of mid-October 2025, gold has set over 50 new all-time highs this year, breaking above $4,300 per troy ounce. Year to date, gold has returned over 60%, outperforming the S&P 500 at 15% and even Bitcoin at 23%. And here's something most people don't realize. Over the past 25 years, gold has quietly outperformed Warren Buffett's Berkshire Hathaway, delivering an annualized return of 10.9% compared to Berkshire's 10.7%. So in this video, we'll break down the economics behind gold's massive rally and uncover who's buying gold and why, even at these record prices. So if you're thinking about investing in gold, this video is for you. Gold demand comes from four main areas: jewelry, technology, investment, and central bank reserves. According to the World Gold Council, jewelry makes up around 37% of total demand, technology around 7%, investment 38%, and central banks 18%. Let's take a look at how these numbers have shifted over time. Jewelry and technology demand has remained fairly stable. Jewelry typically ranges between 2,000 to 3,000 tons a year, with China and India being the biggest buyers, while technology stays around 300 to 400 tons, often used in circuit boards and microchips, essential in many electronic devices. But here's where things get interesting. The real driver of the recent gold surge has been central banks. From 2010 to 2021, central banks were buying an average of 473 tons of gold per year. Then, between 2022 and 2024, that figure more than doubled, exceeding 1,000 tons annually. So why are central banks buying so much gold? Central banks hold reserve assets which typically include fiat currencies like the US dollar, gold, and other highly liquid assets. These reserves are held in order to support their economies and stabilize their financial systems. And historically, the majority of these reserves have been held in US dollars or US bonds, long regarded as the safest and most neutral global reserve currency. But that picture is starting to change. In fact, for the first time since 1996, gold has now surpassed US treasuries in global central bank holdings. So what's behind this shift? Traditionally, gold has been held for a few key reasons. One, it acts as an inflation hedge. Two, it acts as a safe haven asset during a crisis. And three, it also acts as a powerful portfolio diversifier. But a deeper look reveals that something much bigger is going on. A turning point came in 2022 when the global monetary landscape changed almost overnight. During the Russia-Ukraine conflict, the US government froze $5 billion of Russia's US dollar-denominated assets as part of its economic sanctions. This move demonstrated that the US dollar, while dominant, can still be weaponized and used as geopolitical leverage. What had long been viewed as a neutral, safe asset for central banks now carried counterparty risk, meaning that holding US dollars could expose countries to geopolitical and economic pressures beyond their control. Simply put, if a nation were to find itself in conflict with the US, its dollar assets could be frozen, making the dollar far less reliable as a safe reserve asset for central banks. As a result, many central banks began reducing their reliance on the dollar and increasing their holdings of gold. Why gold? Well, unlike fiat currencies, gold is truly neutral. It carries no counterparty risk, it cannot be frozen, and is not subject to any government's political or economic leverage. As the trend of de-dollarization continues, central banks are showing what economists call inelastic demand, meaning their appetite for gold doesn't really change even when prices go up. Between 2022 and 2024, gold prices climbed from around $1,800 to nearly $2,400 an ounce. That's roughly a 33% jump. Yet central bank purchases hardly moved at all, staying steady at around 1,080 tons to 1,089 tons per year. That kind of consistency tells us something important. Central banks aren't chasing price momentum. Their demand is price insensitive, driven by their long-term strategy and not speculation. and 2025 looks no different. Analysts from JP Morgan and other research groups expect total central bank buying to once again reach around 1,000 tons by year end. So what's next for gold? To get a clear sense of where things might be headed, we could take a look at the World Gold Council's 2025 Central Bank Gold Reserve Survey. This year's survey had a record 73 central banks take part, representing a wide mix of both developed and emerging economies. And together, their responses give a pretty clear snapshot of how the world's top monetary authorities are thinking about gold. The key takeaway, central banks remain firmly bullish. 76% of central banks expect gold to make up a larger share of their reserves 5 years from now, up from 69% last year. On the other hand, 73% expect the US dollar share to decline over the same period, which supports the continuous trend of de-dollarization. And importantly, a record 95% of central banks believe that the global gold reserves will increase into 2026, the strongest consensus ever recorded. When asked about what factors influence their reserve decisions most, the top 3 reasons cited were interest rate levels, inflation concerns, and geopolitical instability. Taken together, these numbers show that central bank purchases are strategic, long-term moves aimed at protecting national wealth against economic uncertainty, currency risk, and geopolitical shocks. The world's largest financial institutions are quietly preparing for a more uncertain monetary future, and gold sits at the heart of that strategy. This isn't a speculative bubble, it's a structural shift in the global financial system. It's being driven by long-term changes in how nations and increasingly investors store and protect their wealth. Central banks are leading the charge, but they're not alone. Institutional investors and even everyday savers are starting to see gold as more than a commodity. It's becoming a core part of a hard asset strategy to guard against currency debasement, inflation, and geopolitical risk. In the next video, we'll take a deeper dive into this growing trend, what investors are calling the debasement trade, and explore why smart money is moving away from paper assets and into hard assets like gold, silver, and Bitcoin. If you found this video helpful, please like and subscribe for more insights into economics, investing, and global markets. And if you know someone who could benefit from this, please share this with them. It would really help support the channel and keep more people informed. Thank you, and have a wonderful day.